In the heart of Shanghai's financial district, a quiet unease lingers beneath the city's glittering skyline. Beijing's latest trade figures, released this Friday, have delivered a jolt to global markets. China's exports fell by 1.1% in October, the first decline since February, signaling fresh turbulence in the world's manufacturing powerhouse. For a country that has built its identity on industrial strength and steady global demand, even a small drop carries global implications. The reversal comes just 1 month after an 8.3% surge in exports, a sign that volatility has replaced momentum. Analysts had expected a 2.9% rise, according to Bloomberg projections, but the data tell a different story. Growth has stalled, and the effects of renewed trade friction with the United States are once again being felt. Across Beijing's construction zones, cranes still move and work continues, but a growing sense of caution is shaping sentiment in China's business community. Imports in October grew by just 1%, well below forecasts of 2.7%, while consumer confidence remains fragile amid soft global demand and a slowing domestic recovery. Yet diplomacy, for now, has tempered some of the tension. In Busan, South Korea, Presidents Xi Jinping and Donald Trump met face-to-face for the first time in months, shaking hands in what many saw as the first real sign of thaw since their governments clashed over tariffs and technology bans. The Busan meeting ended with a 1-year suspension of several retaliatory measures, a symbolic pause in a trade war that has shaped the global economy for more than half a decade. For exporters at Yangshan Deepwater Port near Shanghai, the handshake offered cautious optimism. Container traffic there has been uneven for much of the year as companies scrambled to front-load shipments before tariffs took effect. Aerial views of Shenzhen's Yantian port show a similar story. Thousands of containers sitting idle, awaiting customs clearance as shipping schedules adjust to uncertain demand. According to China's Customs Administration, the October figures represent a short-term correction. But behind that official phrasing lies a more complex picture. Exports to the United States rose 1.8%, while imports from the US dropped 11.6%, evidence that the imbalance between both sides persists despite the diplomatic pause. Economists point to deeper currents, inflation in Western markets, shifting supply chains, and growing pressure on China's export-driven sectors. The pandemic years accelerated a reordering of global trade. Multinational firms, once anchored in southern China, are now spreading operations across Vietnam, Thailand, and India. The trend, often described as China plus one, has become a strategic hedge against future geopolitical shocks. As a result, Beijing is now trying to reposition itself less as the factory of the world and more as a hub of innovation and self-reliance. This policy shift, championed by President Xi Jinping, is embodied in his doctrine of dual circulation. It emphasizes domestic consumption as the new engine of growth, supported by technological independence in critical industries like semiconductors and green energy. But the path to that transformation is proving uneven. In sectors such as electronics and solar equipment, US export controls have constrained access to high-end chips and advanced tools, slowing production just as competition intensifies. On factory floors from Suzhou to Guangzhou, the reality is evident. Order volumes are thinner, energy costs remain high, and logistics are unpredictable. One manager, quoted by local media, put it simply, "We're producing, but not at full speed." Even as the central government pledges policy support, exporters are bracing for a lean winter. Premier Li Qiang has urged Chinese firms to shift focus toward high-value exports and stable supply chains. His message, echoed across state media, stresses that openness remains essential. Global cooperation is the only path to sustained prosperity, Li said at a recent trade forum, a line that underscores Beijing's attempt to project confidence amid economic headwinds. Financial markets responded with measured restraint. The Shanghai Composite Index dipped briefly before stabilizing, while global investors paused both the weak trade data and the renewed dialogue between Washington and Beijing. Commodity prices softened, with copper and crude oil falling slightly, a reflection of fears that industrial demand could slow further in 2026. In Washington, President Donald Trump described the Busan talks as constructive but firm, telling reporters that the United States seeks a fair deal that protects American workers and encourages growth, not dependency. In Beijing, Xi Jinping struck a complimentary tone, declaring that competition should not mean confrontation. The twin messages marked a rare alignment, rhetorical at least, between two leaders whose policies have often diverged. But beneath the polite exchanges lies a contest for long-term influence. Beijing's export slowdown coincides with its expanding Belt and Road Initiative, where trade through Central Asia and the Middle East has helped offset losses in Western markets. Officials highlight these routes from Kazakhstan's dry ports to Pakistan's Gwadar terminal as proof of resilience. Still, Western economists warn that overcapacity and soft demand could limit the benefits. Alicia Garcia Herrero, chief economist for Asia Pacific at Natixis, recently observed that China's export deceleration reflects deeper structural changes. The age of double-digit growth is ending. She added that the nation's challenge is now to move from quantity to quality, from assembling goods to designing them. Within China, policymakers are acting quickly. The government has expanded credit to small and medium-sized exporters, rolled out targeted tax relief, and increased support for green energy manufacturing. Meanwhile, stimulus measures aimed at reviving domestic consumption, including incentives for home buyers and small businesses, are being tested nationwide. Yet every policy carries risk. Too much stimulus could revive debt concerns, while too little might stall recovery altogether. For now, the Xi-Trump détente provides breathing space. Behind closed doors, negotiators have reportedly formed a joint monitoring mechanism to oversee the suspension of tariffs and review new investments. US officials describe the talks as technical but productive. One senior diplomat told AFP that the real test will be 6 months from now, when both sides must decide whether dialogue can outlast politics. Meanwhile, global trade routes are adapting. Major shipping companies like Maersk and COSCO have revised forecasts, predicting slower trans-Pacific routes but faster growth across intra-Asian lanes. This reflects an emerging pattern: shorter regional supply chains built around China rather than dependent solely on it. Inside the National People's Congress, President Xi continues to link trade resilience to national security. In a speech earlier this month, he asserted China's modernization must remain open to the world, but on our terms. The message, firm but not defiant, aims to reassure both domestic audiences and international investors that the country will stay engaged, even as it redefines the rules of engagement. Across the Pacific, US business groups have cautiously welcomed the pause in trade hostilities. The US-China Business Council stated that predictable trade conditions are essential for stability, but political headwinds persist in Washington, where debates over tariffs, manufacturing jobs, and national security continue to shape economic policy. Both governments face domestic pressures that could quickly harden positions once again. Economists expect a modest recovery toward year-end, assuming inflation in advanced economies cools and supply chains regain balance. Yet the outlook remains fragile. A flare-up over technology access, maritime disputes, or currency management could easily reignite tensions. For businesses on both sides of the Pacific, uncertainty has become the new normal. From the factories of Guangdong to the ports of Shanghai, China's exporters continue to move goods fewer than before, but enough to keep the world watching. Each shipment reflects a delicate balance between economic pragmatism and political strategy. A 1.1% fall may sound minor, but in the scale of the world's second-largest economy, it is a warning, a measure of how tightly global prosperity is now linked to China's pulse. As the lights dim across Shanghai's skyline, one truth endures. In an interconnected world, no handshake is ever just a handshake. It can steady the markets, shift alliances, or spark another round of rivalry. For now, the Xi-Trump meeting in Busan stands as a fragile truce, a moment of calm before the next test of global trade diplomacy. And so the story of China's exports and the politics surrounding them continues, shaped by numbers, driven by power, and watched by every economy that depends on the flow of trade.